We've got Sandip Bhagat from Whittier Trust, CNBC market analyst Steve Grasso from Stuart Frankel, and Rick Santelli at the CME in Chicago. So, all in all, would you say that there's been a softening on trade? We've heard from the president both today and at the rally in North Dakota last night, still hammering away at the points.
Right.
But as far as the policy action, have things calmed down?
So we haven't really seen any policy action yet. So yes, I think that the rhetoric is always going to be out front. Markets react to rhetoric versus the reality of the actual trade. And when you look at what moved the markets on Monday, it was the China investment or blocking of a China investment here. That's what moved around the technology space ahead of the rotation tomorrow, month end, quarter end. So I think you sort of preloaded with the marketplace. Right now, you see us up 20 handles, S&P cash.
Yep.
So if people started to get ahead of that rotation where you sold tech and tech was supposed to be for sale because hedge funds and funds want to show that profitability on those good trades, they want to get rid of those, show the profit, and they want to buy the laggards into it. That's why you've seen that reversal or rotation that's taken place this week. But let's also remember, buybacks are blacked out right now. So that has been a huge tailwind for this marketplace. We're going to start ramping into earnings season. So if that EPS guidance, if those revenues are there with earnings, the market can still levitate back to or around old highs. And maybe the sell-off for now or the funeral is probably a little presumptuous.
Sandip, have you been a buyer of the technology sector in the last week or so as the opportunities presented itself?
Look, the most powerful secular growth story related to today's information revolution is unfolding in tech. So to be underweight tech at a time like this is like being underweight manufacturing during the Industrial Revolution. We think valuations are still reasonable in this space. This is not like the late 90s. And these valuations look even more attractive given the growth rates that these companies are producing and the fact that there is a secular trend to support that in the absence of cyclicality and violent swings up and down in earnings.
I mean, what do you include when you say technology and that you have to own it? Do you include the semiconductor stocks, which have been really hit hard on some of these trade concerns? A lot of their revenue exposure is overseas in places like China in such a globally interdependent kind of industry.
So semiconductors, industrials, those that have been hit hard with what we view are exaggerated trade fears would make for a nice kind of tactical play for a rebound in the near term. But the things that we like on a long-term basis, look, we feel that the best way to maximize long-term intergenerational after-tax wealth is through the ownership of very high-quality growth companies. And Alphabet, for example, falls in that category. Here is a company that is growing sales and earnings in the mid-20s. The digital ad business is strong. Autonomous driving just got spun off. Android is gaining market share. These are additional drivers of growth, and yet the stock is trading at a forward PE multiple of only 24 times.
Rick, the dollar today is relatively calm, but really found some positive impetus the last couple of trading sessions. What's behind that, and will it continue?
You know, I think there's a variety of things behind it, not the least of which is China, of course, most likely, quite intentionally, creating their sixth fix in a row that puts the dollar stronger against their currency. I also think the fundamentals of the U.S. are much better than the rest of the globe. And I think the investment capital will find its way to the U.S. after we get through the quarter and half year issues and get past the holiday next week. I really do think that the dollar index may surprise us and do better. I thought once it hit 95, it would start to slow down a bit, and for a while it did. But I like this resurgence, and I know that there's going to be the litany of conventional wisdom, that the strong dollar, of course, is going to be a real headwind for multinationals. I've always thought that that was a really rotten reason to hope for a soft currency.
Well, there's also exports, and I mean, there are a lot of other ways it can wreak havoc. I will tell you, the best trade ever was to buy the dollar when Larry Kudlow went into the White House as chief economic advisor. Remember when he came on closing balance at
indeed.
King Dollar, and it's in the best interest to have it like dollar straight up.
Since then, but it did have a couple of weeks pausing for breath, I guess. Steve, before we wrap up the closing bell exchange, CCAR results, the second round of the bank stress test come out at 4:30. The banks have been super weak of late. Is this going to draw a line under that weakness? Is it kind of the catalyst that the stocks need?
So when the marketplace, when you see this little bounce late in the day and you start to see tech performing a little bit better and you see pretty much financials are performing better, people push that short so aggressively because we had about 12 or 13 straight down days in the XLF, and ahead of the CCAR after the bell, they scrambled to cover. So let's see what those results are to see if it's more than just a one-day pop.
We will keep an eye on that. Gentlemen, thank you all very much. Sandip Bhagat, Steve Grasso, Rick Santelli, thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.